Next, we'll look at the use of ratios and standards in your business. So remember that ratios provide a very specific information or information set that allows the financial manager to compare their current situation or expected financial situation of the business or enterprise with others that are similar as far as other businesses or enterprises or organizations. When we talk about ratios, we're going to look at a standard industry code, also known as a SIC. Comparisons are made between the enterprise in question and the class of businesses represented by the appropriate code, and that's what we're going to look at. So here's a sample from the North American Industrial Classifications for the SIC, those codes we were just discussing. So you can see they've got different things lined out here for like gambling. Casinos is 7132. Things like scenic and sightseeing transport for land, water, and other transportation is going to be 4871-9. So they've got a lot of different codes here, and they're used for those different ratios and standards. So in consideration of SIC codes and ratio standards, ratios reported in financial publications are often given for businesses that differ in sales, output, asset value, or place within the range of reported ratio values. Some publications list ratios and others important financial data for similar enterprises across a wide range of sizes and businesses. So if we look at like the current ratio, which we talked about previously, our current ratio for a business per se is 2.0. The industry standard is 1.2. So in this example, our ratio is much higher than the industry standard because we do not need to maintain large inventories to meet our short-term obligations and so forth. So again, we're looking at an industry standard as one number for that current ratio, and ours is a little bit higher. And then we can look at the like debt to equity ratio. Ours is 0.83, and the industry standard is 0.87. So here we can say we're pretty consistent with that. And the same with the return on sales ratio. The industry standard is 0.07, and we're set at 0.05. So, I mean, we're pretty close. But in general, what we can do is we can look at these and see how we compare to other industries or other businesses within our industry. So here's another way to look at it as well, is we can look across different codes. So if we look at liquidity, so if we look at something like current liability to net worth as a percentage, if we look at the average throughout, or the standard throughout physical fitness facilities, we're looking at 17.5, right? And then we look at hotels and motels, and we're looking at 32.1. And then, of course, or across there is public golf courses, looking at 33.9. So overall, you can see there's a range there, but where do we fall in, or where do we fit within those different sectors? So if you're looking at your company and you're looking at, you don't specifically fit one or the other, you can look at it across different ones and look at different things. We can look at liquidity, activity or efficiency, and then profitability as well. And just look at how there are different rates or as a standard across the board. Overall, it's important to remember that each report emphasizes different information and presents it in a way that addresses specific or particular questions. So some certain questions we can look at is what happened, what's current situation, what are our future needs, and how does our performance compare to some other business or entity. Financial reports are not independent of each other. So a good example is petty cash accounting is reflected in a balance sheet and the income statement. The balance sheet is also used in compiling the income statement and appears again in the ratio analysis. So these all work together. There's a relationship between all of these. And here's just a quick graphic showing the relationships between all these different reports and the analysis and so forth. And I'll leave this up here for you to take a gander at it for a second. All right, to summarize, financial accounting not only tells a story of what has occurred and what is now the financial situation, it's bigger than that. Accounting allows for planning and evaluation, aided by informative and accurate reports. Cash flow analysis and ratio analysis are important management activities throughout your business. And finally, reports facilitate planning and evaluation, are based on data contained in the stock and flow reports.